Best was founded in 1899 by Alfred Best with the intention of providing information to the public about the security of the insurance industry for the benefit of the policyholders of those companies.
Alfred M. Best pioneered the concept of insurer financial strength ratings in 1906.
Though the origins of AM Best are in the United States, we were founded over a century ago, and now our reach is truly global and supported by offices around the world.
AM Best is considered to be the world's leading provider of insurer financial strength ratings by company coverage.
An AM Best financial strength rating is an independent opinion on a company's ability to pay their claims.
An AM Best credit rating is the result of a comprehensive qualitative and quantitative analysis of many core key rating factors, specifically balance sheet strength, operating performance, business profile, and enterprise risk management.
AM Best is the only rating agency with an exclusive focus on the insurance sector.
We have developed bespoke and specialized criteria for all the different segments in the insurance industry. Our methodology provides consistent and comparable ratings across the industry globally.
AM Best in the Asia Pacific is seeing an increase in the demand for insurance and reinsurance ratings, which is very exciting. We believe obtaining a rating helps a company mature and grow in their respective market.
AM Best, delivering insurance and reinsurance industry insight, analysis, ratings, and expertise for businesses across the world.
Welcome to the AM Best Market Briefing at the 16th Singapore International Reinsurance Conference. Scott Ryrie, Co-CEO, AM Best Asia Pacific.
Welcome. Scott Ryrie, and based in Singapore with AM Best, as you know, and I'd like to introduce firstly our panel. Ladies first. Christy Lee, Head of Analytics in Greater China, Japan and South Korea. On your far right, Miles Gould, Head of Analytics, Southeast Asia, Australia and New Zealand. And on your left, Greg Carter, Managing Director, Analytics, EMEA and Asia Pacific. Greg was previously based in London, running all the analytics for Amsterdam, London, Hong Kong and Singapore. He's now moved here in Singapore, which is fantastic, very excited. So welcome to the AM Best SIRC 2019 Market Briefing. We have quite a lot to get through, and we wanted to facilitate your questions as much as possible by using Slido. So hopefully you were given a pamphlet as you walked in. Logging in is very easy. I did it on my first go. So log in and you can do two things. Ask questions, and please do as we go through. I'll be referring to the questions on Slido. And secondly, we've got two questions later to poll the audience on their opinion on a couple of market issues, which are quite important. So we'll get straight into the agenda. Firstly, we're going to talk about the rating methodology. Then we'll do a reinsurance market update, some very important issues on cat loss reserving, risk-based capital, and the most exciting issue is the last one, which is IFRS 17. And I know you're absolutely enthralled at what we will reveal in that. We'll get to that at the end, and we left it to the end deliberately, just in case we run out of time. So firstly, Greg Carter on AM Best rating methodology. Greg.
Thank you, Scott. Thank you. I'm delighted that Scott's going to be the compere today, because I was in the session this morning with Herbert Frommer. I don't know how many of you attended that, but Herbert's quite scary when he gets going. I think Scott's going to be hopefully a bit gentler with me. So I'm just going to run through a few slides. As Scott said, we want it to be interactive, so if you've got questions, the lights are a bit bright here, so you might have to wave rather than just put your hand up. But if you've got questions, do stop us as we go. I want to start with just one slide that talks about our methodology. This looks quite busy. It looks like there's quite a lot going on this slide, but it's something that we introduced a couple of years ago, really in response to one of the biggest criticisms of rating agencies, and that is that we're not transparent enough, our process is too much of a black box, and it's difficult for outsiders and even companies that are rated to fully understand our process and our methodology. So this slide was designed to help improve, open up that transparency and make it a little bit easier to understand our processes. So I'm just going to spend a few moments talking through this as to how we reach our conclusions, how we can produce our financial strength ratings. And key for us is the starting point of balance sheet strength. Any company needs a strong balance sheet in order to meet its future obligations, and that's what our financial strength ratings are trying to measure, a company's ability to meet its obligations to policyholders into the future. So our analysis starts with a mixture of quantitative and qualitative assessments that start off with a baseline assessment, and we start that on the traditional AAA scale, AAA down to as low as single C, and that's our starting point. We then make an assessment of operating performance because a company needs a strong operating performance. It needs to generate earnings and create capital, future capital, in order to augment its balance sheet. So when we measure operating performance, we then adjust that baseline assessment potentially up 2 notches. So if you started off at an A- here and you had the strongest operating performance, then the next stage would be to move the rating up to A, through A to A+. Similarly, poor operating performance could take you down by up to 3 notches. The next major area of our analysis is business profile, and here we're starting to move into some of the more subjective elements of our analysis. This is to do with market share, it's to do with the company's strategy, the quality and track record of their management. But you need a good business profile, you need a good market position in order to be able to generate the earnings in the future that will then augment your balance sheet. And we think this is a sort of logical process, a logical way of stepping out the analysis. Similarly for business profile, a very strong business profile can take you up 2 notches, a very weak business profile can take you down 2 notches. And then the final major step of our analysis is to assess enterprise risk management. And here you can see there's only one possible notch up for having strong enterprise risk management, but there's potentially 4 notches down. And our reasoning for that is, if you have poor risk management running across the company, well, you may have started from a position of a strong balance sheet. Your operating performance might have been quite good in the last few years. You may have got lucky. There may have been no cats. In that scenario, we're not fully recognising the risks to the rating that come from poor risk management and weak governance. And that's why we have potentially 4 notches negative movement for ERM. The last 2 blocks are very rarely used. The comprehensive adjustment, I know the lift and drag really only applies for companies that are part of larger groups. So hopefully that sort of sets the scene. And as we talk through some of the issues, we may make reference to some of these individual building blocks and the impacts that certain market features have on how we look at some of these building blocks. So hopefully that's setting the scene. It's a very simplistic approach, view of our methodology. If there's any questions, I'm very happy to take them now, otherwise we'll move on.
There is a question actually, Greg,
Okay.
which is inherent in this. What is the current level of technology adoption by reinsurers, and let's expand that to insurers, for data analytics in your opinion? And I would add, and how does this fit into the process?
Good question. So how companies are making use of data analytics, we see in different markets different levels of penetration of data analytics. We see it particularly across the mature markets and across the larger multinational players. There's a lot of investment going into data analytics, a lot of assessment of trying to analyse the trends that companies are seeing in their policyholders, trying to identify buying patterns, and really that would factor more so into the business profile because it's part of their strategic approach to how they win and retain business, how they select risks to a better extent. So we would probably recognise that mostly in business profile. The companies that are further advanced in data analytics and can demonstrate that it's helping to improve their earnings, well then there may be a benefit to operating performance. Now, in the grand scheme of things, simply having a great data analytics capability, using it and producing better results, probably doesn't add a whole notch to any one of these categories, but clearly it would be a positive supporting factor. The risk would be if companies become too dependent on the data analytics and they're not making the right judgments, and that then could have an impact on enterprise risk management. But I don't think we see any companies in that scenario.
And we have another question, which is a curly one, and you've only got a very short period of time to answer it. But as these questions are transparent to you, and we are very transparent in what we do, how is your methodology different from other rating agencies?
Okay. So the key element, I always describe rating agencies' methodologies, it's a bit like designing a car. If there's an aerodynamic perfection to be achieved, then all rating agencies ultimately will tend towards the same outcome. But how you get there, how you design the wing mirrors and the wheel trims will vary. But there is one very important difference, I think, with our methodology compared to the other rating agencies, and that is to do with our treatment of sovereign ratings and sovereign caps. Many of the other major rating agencies rate sovereign territories, and they use those to, if not to provide a formal cap, to effectively provide a cap on ratings. And it's rare for companies to be rated at a level higher than that of their sovereign in which they operate. We've seen over the years many companies in territories where the sovereign has defaulted on its debt. So the sovereign rating would be down in the Ds or certainly in the Cs, yet the insurance industry functions perfectly well and continues to operate. So we believe that element of sovereign risk or country risk should factor into our analysis, and it does feature in all our balance sheet strength, operating performance and business profile blocks, but it doesn't provide a cap. We could do a whole seminar on country risk, so I'll probably stop at that point if I may.
Yep. Okay. As you're walking back, we've been asked, is Fitch A equal to AM Best A minus? How?
Each year the rating agencies have to produce a table of a default study and a transition study that shows the default rates of our ratings over a period of time, a long period of time. And if you look at the analysis of that, then there is no difference in the A minus level between ourselves and Fitch and S&P and Moody's. There are minor statistical differences in the default experience. But in terms of some of the steps, some of the comparisons, it's impossible to suggest, it's misleading to suggest that if you compare a financial strength rating with an issuer credit rating, then you could be mixing apples with pears and not making a fair comparison. So the statistics back up very well. We produced a paper on this very subject about 18 months ago. And if anyone wants to see me afterwards, I'll make sure you get a copy of that, and we would defend that position quite robustly. Thanks, Greg.
We've had a question on country risk, which we don't have time to take now, but if the person could see me afterwards, we can explain that. We've really got a lot to get through, and I do want to deal with that question later, if you don't mind. Right, let's
okay, well, I'll crack on. So I'm going to give you a couple of slides that set the scene for the reinsurance market update and our views on the reinsurance sector. Clearly a very big topic of discussion this week. For many years, we had a negative outlook on the sector. And that didn't mean that we were expecting more downgrades than upgrades, but we felt that the reinsurance industry was operating in a pretty tough environment where the opportunities to grow, to add value, to expand business were under severe pressures. At the end of last year, we moved that outlook to a stable outlook, really reflecting our view that the industry had come to terms with a different environment, a low interest rate environment globally, and a situation where the market had excess capacity and continues to have excess capacity over the long term. Emphasising this point was the performance of the industry. This is our analysis of the top 25 reinsurers globally that produce results that we can then aggregate. So this probably represents around about 75–80% of the global reinsurance market's performance. And what you can see from here, we had a long softening cycle from the post the cat events 2011, we had a period where results just gradually deteriorated for the industry. And then you had 2017 with the major cat losses, particularly the US windstorms, and also 2018 as a year of cats. This reflects the competitive nature of the marketplace. It reflects a pretty poor return on equity over that period. And that long softening cycle was why we were having a negative view. But we reached a conclusion that the industry had learned to cope with those pressures, had learned to find niches to cope with the catastrophe events. And if you look at the total losses, the insured losses that were incurred in 2017 and 2018, I think the number is something like $219 billion of losses to the insurance and reinsurance industry. Actually, a combined ratio of 110 is not that bad. And certainly the 2018 performance reflects something of a reaction to those market conditions. But if you look at a 5-year average, a combined ratio of almost 98%, that's not a great performance. And one of the features that we think influences the market is the speed at which capital comes into the marketplace now. If you go back 20, 30 years, after a major cat event, what happened? New reinsurers set up in Bermuda. It took several weeks to get licensed. It took weeks to get the capital in place. It took months to get the infrastructure, the management, the systems, get the company operating, get the relationships going with the brokers, and start to write business. So after a major cat event, you had a crisis of capacity, prices rose, and it took almost a complete renewal cycle before that capacity was really felt in the marketplace. Today, you have alternative capital coming in through ILS transactions, through sidecars, through cat bonds that bring capacity into the market almost overnight. So we call it capital elasticity. This sort of speed of capital coming into the market means there's never an opportunity for a long, hard cycle. And you typically now get very short, hardened cycles, but typically only in certain lines of business. As I mentioned, $219 billion of losses over a 24-month period has got to have an impact on terms of how companies operate. And we've seen some of the operators like Lloyd's and AIG totally refocusing their underwriting efforts to look at profitability and to cut out underperforming business. And then in recent months, we hear much talk of a crisis or a crunch of capacity in the reinsurance, in the retrocessional markets. And primarily that's come about because of the form of that alternative capital playing in the retro market, and the losses of 2017 and 2018 ending up with a large share of that collateralized capital, collateralized capacity being tied up and being not being able to be redeployed. And that's caused some of those investors to pause and think about whether they want to be in the market. And whilst we consider that earnings have been under pressure, that combined ratio drifting slowly upwards, we still think that there is reasonably strong demand for reinsurance from the primary markets. The primary markets themselves are under pressure, low interest rate environments, low earning opportunities. The desire to offload peak exposures and volatility means that there should be an ongoing demand for reinsurance. So you've got a number of factors that are influencing whether the sector is going to continue that hardening trend that we've seen in recent months. I paint a sort of fairly negative view at times, but I think there are lots of opportunities for the reinsurance sector. And I've put up 5 here. I think some of these have been discussed already during the conference, so I don't intend to go into any of them in any great depth. But I don't want to give the impression that we're all doom and gloom, particularly as we have moved to a stable outlook. And we are seeing companies growing their books in these areas and trying to take advantage of the opportunities that exist. So just to summarise our view on the global reinsurance market, there's a number of headwinds and tailwinds, and overall we see them as balancing out, and that's why we've moved to a stable outlook. There's just 2 here I want to comment on very briefly. Firstly, this excess capacity, which has been a feature of the market for many years, and we just don't see that changing. That's something that the market is getting used to and is going to have to live with. The other key point to highlight is that continued trend from third-party capital. That alternative capital came in, some of it's been tied up, it's paused, but we hear stories of many more investors waiting on the sidelines for the right opportunity to come in. So alternative capital is a part of the market that I think is never going to go away. But the third factor to mention is that what we see nowadays is a convergence of those two factors. Third-party capital, which was seen 5 years ago as a major threat to the reinsurance space, is no longer seen as a threat. There was a comment on it this morning, actually. Herbert Frommer mentioned that the large reinsurers were very wise to the threat of third-party capital. So what did they do? They embraced it, and they partnered with it. And increasingly, we see that alignment. And if you look at now the two largest third-party capital providers, they're either owned by or aligned to traditional reinsurance capital. So there's a convergence going on in that space. So, I think I skipped a... So they're my comments on the reinsurance market sector. Do we want to take questions or move?
We will have one question. I do have one question, which you've pretty much answered. Do you expect more liquidity to be locked in the ILS market? And I think
to be locked?
Come into, I guess.
We do expect more. We've seen some of the existing investors pause and think about whether they want to reload. But we hear stories of new investors who aren't currently in the marketplace looking at opportunities as well.
Okay, thanks, Greg. Let's move on to cat loss reserving. Thanks for the questions. They're all from Mr. Anonymous. You can put your name on it, but I won't ask you a hard question.
Okay, so just a few comments. I'm then going to hand over to my colleagues. You must be getting fed up with my voice by now. Cat loss reserving. We just want to pick out some trends that we've noticed over recent years that we think is actually becoming more of an important factor, particularly in the cat markets. And specifically, I think many observers would have said that cat business is typically, it's short tail. At the end of the year, you know whether the wind has blown. But what we have seen is some interesting trends. So particularly with Hurricane Irma, but also with Maria to an extent, we saw a much longer claims development pattern for emerging from these losses. And some of that was to do with the slower development of flood losses that arose from those events. But there's one particular factor that I just wanted to comment on briefly, and that was in Florida, this what they call assignment of benefits. So this is a situation where you had claims that had been settled, and from an insurer and a reinsurer's perspective, they're closed. The US legal system, for all its wisdom, found an opportunity to reopen those claims, and the benefits that were assigned under those policies could be given to third parties, and the legal process then enabled those claims to be reopened and further claims to be made under those policies. And so we've seen a rise in recent years. This is a Florida-specific event, that the lawsuits increased from 1,300 nearly 20 years ago to 135,000 the year before last year. And so what we've seen is where companies have closed their books on a year of account, particularly in respect of Irma, we've seen these losses then creep or develop further. There has been some changes in Florida in the law to try and close this down, and we're not yet convinced that it will do so. But what this has emphasised is that actually when you think that a hurricane, once the losses have emerged, you know the losses and they've settled, there is scope for a further development. Christy.
Okay. So I think last year, the Typhoon Jebi is also a good lessons learned in terms of loss creep and also cat loss reserving management. I think loss creep has been a recurring theme in reinsurance market. And last year, there are multiple factors that contribute to the surprise to the reinsurance market, why Typhoon Jebi has gone up so much from the initial estimates. Initially, the cat modeling company, they're estimating in a range at much lower, such as like $3 to $5 billion. And it turned out to be right now estimate around $12 to $13 billion. But I think I have to really say that like it also reflects the company's understanding of cat modeling output. When AIR and RMS are putting the estimates out, they have state what are actually modeled, what are excluded, such as AIR is, they have stated that like business interruption, CAR, AAR, etc., those are excluded in the cat modeling estimates range. And so I think it reflects how insurance and reinsurers, are they just capturing the range and they have missed out the part of unmodeled risk. So this is the driver of the first phase of the loss development for Typhoon Jebi. Secondly, there are 700,000 fire policies being involved in Typhoon Jebi, and followed by complicated by Typhoon Trami hitting the same area within a month. So there's a huge demand surge on surveyors and also repair workers for getting the claims closed, and that contribute to the residential claims development. That we observed from GIAJ statistics from November to December, the claims amounts has developed for 30%, and it developed another 30% from December to March afterwards, and the claims has more stabilized. And last but not least, over the whole surprise that reported by reinsurers, I think that also reflect the information asymmetry in the whole value chain of insurance industry. So the direct companies and the reinsurers who are onshore in Japan, they have they can access to the information on more timely basis. And we see that the direct companies and also some reinsurers that we rate, actually they could reflect accurate cat reserves in the book by the end of the year, while there are some other reinsurers who have to book a very huge reserve strengthening in 2019.
Thanks, Chrissy. We've got a couple of questions coming in. I think one for Greg, and these are, if we could make them pretty snappy. Greg, is cat loss reserving, is it going to be a capital event for reinsurers, an impairment event? Now, through scale, you've got to scale it up, haven't you? You've got to scale what is the loss.
Yeah. Is it a capital event? I don't think we see it as a capital event at this point, particularly when you've got longer tail development issues. Then it's not an overnight event. So typically what we've seen is companies having to add to reserves for prior years. It's made an impact on earnings, but we don't yet see it collectively as a capital event.
Okay. And another quickie, how quickly does AM Best review reinsurer security rating post a major cat event, or does it wait till the end of financial year? That's an easy one to answer.
Yeah, our ratings are considered to be current and live, so they're constantly open for review. So if a rated entity has a cat event exposure, then we'd be in touch with the company immediately.
Yep. There's another question on CBI and cats, which I think Christy will deal with a bit later when you do your graph. Mm-hmm. So we'll move on.
Okay.
That's good.
Okay.
Next slide.
Next.
Yep.
Mm-hmm. Okay. So again, for Typhoon Jebi, it's the most costly event, typhoon event for Japan so far. And 2018 was also the most expensive typhoon years for Japan. But the key message here is it's not extreme scenarios. So insurance and reinsurance companies should be prepared for even worse scenarios. Here we have ranked the top 10 historical largest wind flood loss in Japan. And the dark blue 3 bars represent the 3 events from Japan last year. So the July heavy rain, Trami, and Jebi, they're all within the top 10. However, if we're considering historical events, that are recurring today, and considering the as if losses, actually they could be quite sizable and they could exceed JEBI. Also, including 2019, there are 2 years in a row of major typhoon cat loss to Japan. But is that something that really surprising the industry? If you're considering like 1958 and 1959, where Ida and Vera, where if they happen today, AIR estimating they could be like 17 billion and 22 billion losses, which could be similar to nowadays that we see Fasaya and Hagibis, where the industry estimate that it could be potentially as sizable as Trami and JEBI together. So overall, the industry should be prepared for more severe events. And our opinion on the Japan domestic non-life insurers is that they have robust capitalization as well as adequate, appropriate reinsurance structure so that they will be able to sustain the losses from Typhoon, JEBI, and Trami last year, as well as Fasaya and Hagibis this year, where we estimate the total net loss to the industry will be within 200 billion Japanese yen, roughly about $2 billion on net basis. And also thanks to the cat loss, the cat loss reserve regime that also helped the industry to smoothen the P&L of the industry.
Thanks. Miles.
Okay. So just a short slide here in terms of what I think is quite a unique case, actually, and really just comes back to Greg's initial comments. When we think about property cat losses being relatively short tail in nature, this particular case, we're coming up towards a decade on from these two events. So this is New Zealand and the earthquakes that most of the people in the room will be familiar with from September 2011 and February 2011. Sorry, September 2010 and February 2011. The specificities for this case is a very long list, but some of the things that were pertinent to the tale of some of these exposures and the fact that there's still a number of open cases, and in fact reopened cases, is the interplay between the insurance market operating in New Zealand, but also the Earthquake Commission, which has been in place for many years to really ensure the affordability of insurance products for the property side of the market, particularly in the cat-exposed areas of New Zealand. And the complexity that is key in this case is that these events happened in quite quick succession, and that at the time there was a cap from the Earthquake Commission in terms of providing that first layer of protection before it hits the insurance market at 100,000 New Zealand dollars for each property. Now, as these events happened in quite quick succession, the loss assessing for the first event was still ongoing when it came to the second event. And what that means is you've got potentially 200K caps for each event, but it wasn't fully clear for the market and for the Earthquake Commission across all of the properties that were damaged, the level of damage and injury that was created from the first event versus the second event. So this has created quite some complexity in terms of allocating exposures between the first and second event, and ultimately that determines whether the insurers above that 100K cap are picking up exposure here. In addition to that, what we've seen over a number of years is actually a significant volume of cases that have been reopened. And this really comes to the structure and approach that has been taken from the Earthquake Commission in the original years of 2010 and 2011 in terms of assessing those claims and paying out. Now, if the original claim was expected to be below 100K, it retains with the Earthquake Commission to manage. But a number of the inspections that were conducted at the time were actually external only. And what has happened over a number of years is that when people have gone to sell their properties or move on, there have been internal inspections to the structure of properties, which has actually shown further damage and caused cases to be reopened. And in addition to that, obviously with a significant demand surge for the construction industry after the 2010 and 2011 events, we have seen quite a high instance of substandard repairs. And I was talking with some companies only a few weeks ago that were indicating that there are claims out there that have been subject to repair and remediation work up to 4 times. So the interplay between the EQC's exposure and the insurance company's exposure above that cap has been complicated throughout that period and remains an important consideration, an ongoing dynamic for the insurance companies operating in New Zealand today, as well as the reinsurers sitting out the back of that as well. So I think that's just an example of how long some of these property losses can go on for. I do note it is quite a specific case, but quite an interesting one nonetheless.
Thanks, Miles.
Okay.
We've dealt with the big end of town in terms of cats here, before we go to the Slido question. But also, obviously, we're still dealing with attrition across Asia Pacific as well. Examples, Tropical Storm Matmo about to hit Vietnam, possibly to then travel over Cambodia, maybe even to Thailand. So that's ongoing right now. We've got the Australian bushfires, which are really quite bad because of the ongoing drought. We recently had a Philippines earthquake in Mindanao, 6.6, plus hundreds of aftershocks. When I first came here in 2002, my underwriter said there's a few countries with no cat in Asia Pac. Well, actually I don't think there is. Everybody gets something. I've felt 2 earthquakes in this town and seen a few floods. So it's all happening, as they say. Right. We have, if you go to your Slido, please, to the poll section at the top of the blue line. Have reinsurance bottomed out? There's some voters in the go already. That's good. So it's not as close as the referendum on Brexit, is it?
Oh, hang on, not sure. It's just come back into it.
Okay, we'll now go to the second question, please, which is, have retrocession rates in Asia bottomed out? Oh, it is Brexit-ish.
It is, yeah.
Interesting. Any retro brokers in the room? No? They're all too busy. Is that a sign? Quite a lot of capacities withdrawn. It's been quite a lot of hits.
That's
Greg.
interesting. That's in contrast then to what we're hearing in many markets, that there is a crunch on capacity in the retro markets and prices are starting to rise. It's not so much pricing as capacity as an issue. So maybe there's lots of retrocessionaires and reinsurers that are still happy to employ their capital in Asia.
That's good.
I would like to comment the previous question on the reinsurance rates.
Yep.
So there is a common theme that we heard from SILC that Japan definitely, with 2 years in a row of huge losses. Last year, when they were doing the renewal in 4/1, the loss creep was not fully reflected in the pricing. Is 15 to 40% increase last year sufficient? Probably not. With this year, another 2 big events. So the market, if they're demanding higher rate increase, that would be within expectations. However, one thing I notice is Asia is always, when there's a demand on the rate increase, is very localized. So whenever there's a rate increase demand because of loss, it's only impacting the loss impacted jurisdictions, where it doesn't have a spillover effect to other countries. While I think the key message in Greg's slide showing that the combined ratios of reinsurers being above 100% for the last 2 years, and is expected to be another earning years this year, probably the reinsurers have to think about, there should be increased demand on increasing rate overall to keep the overall industry more healthy.
Okay. I've got one question. Okay, we'll go back to the slides, please, just while we're doing that. One question from Kent. Thank you for owning up to this, Kent. Probably to Greg. With the influx of alternate capital into the reinsurance industry, which has lighter touch regulation, what is AM Best's approach to rating these entities?
Entities in lighter touch?
On ILS in some jurisdictions, not all.
Okay. So I think that's a good question. So how would we view it? From a credit perspective, capital that's operating in a light touch regulation is generally, we would say, is less likely to be there to support the obligations. Why do you want to operate in a light touch regulatory environment? Well, okay, nobody likes regulation, but why would you choose a very light touch regulatory regime? It tends to attract not just the capital that's looking for efficiency, but capital that doesn't want to hang around, that is not committed to the industry. So our view, generally speaking, would be a highly regulated environment is good from a financial strength perspective. It improves credit quality because the regulation is built around ensuring that security. So whilst we recognise that having capital sourced from light touch regulatory regime may improve the efficiency of capital, it may improve, therefore, it may ultimately result in lower pricing for the consumer or the purchaser. From a credit perspective, that's generally not a good thing.
Okay, thanks. All right, we better move on because we're conscious of time. On to RBC update.
So just a few comments on the developing capital regimes across the region.
Lars.
Okay. So this is a very busy slide, and I don't plan to speak about individual markets. The individuals in the room will already be aware of the specific developments country to country that we've seen over recent years. And we have a wider report covering this in some detail, which we can direct you to if you're of interest. So what I would like to do is just touch upon some of the key themes that we've seen. This is particularly across the Southeast Asia component. Christy will talk about Northeast Asia shortly. And I would like to link that back a little bit to what Greg started this session with in terms of the building blocks and where we see this potentially having an impact to date, but also over time in the future as well. So I think my first point would be that the regulatory developments in respect of risk-based capital frameworks, risk-based capital regimes in Southeast Asia have generally been continuous and ongoing. We have not seen step changes in most of these markets, which result in companies having to deal with significant changes in terms of the requirements or how capital is viewed overnight. And I think this is good from an insurance company's perspective, but from a regulator's perspective as well, when you're looking at remaining competitive and attractive to the industry. But nonetheless, from a stakeholder perspective, from a regulator's perspective, insurance and reinsurance is increasingly done on the international stage, and it is important that markets across the board continue to develop their regulatory frameworks and risk-based capital to remain competitive and within the confines of what is viewed as a robust regulatory environment. So I guess to touch upon some of the key themes that we've seen across all of these markets, I think we've seen risk-based capital through RBC1 moving on to RBC2 in a number of these markets, and a lot of fine-tuning and further development of the regulation that sits behind this. Beyond just looking at the ratio, I think we've seen a wider development around how capital is managed and how it's planned for businesses on a prospective basis. So in some of these markets, we now have ORSAs and ICAP assessments, which has resulted in management teams having a greater understanding for capital requirements into the future, planning for changes in their business, and really starting to understand some of the key sensitivities around their capital positions and also what happens in the events of stress tests. So I think that is all good, and it certainly has improved our view of balance sheet strength and risk management over time. I think it is critical to continue to say that our view of risk management is not something that doesn't change. So when we're rating companies, we do expect over a period of time as the market develops, for companies to keep pace with that. But certainly the enhanced regulation and risk-based capital regimes that we've seen come into play over a number of years gives greater comfort around the volatility of capital management and also businesses being better prepared for shock events. And the last thing I would like to say is really, not just in Southeast Asia, but the world over, obviously there have been significant events, significant changes in the operating landscape, which does mean that capital models and risk-based capital frameworks need to develop to factor in those additional risks. So Greg touched on some things earlier in terms of cyber risk. Operational risk is obviously a key consideration, and capital models and the frameworks have developed to incorporate that as well. So that's all I really had to say on this slide. So back over to you.
Thanks, Miles. Before we go on to Christy, just a quick one with Greg. Greg and I were talking yesterday about Southeast Asia and the RBC implementation timelines and things. And I said to Greg, is it different elsewhere in the world in similar markets where they're up to a similar stage of new regulation, M&A, too many companies?
We're seeing, well, if you look at the Western European markets, obviously you've got very well developed and embedded risk-based capital regimes. You've got Solvency II operational across Europe, which is a reasonably, a very sophisticated approach to risk-based capital. If you look across some of the other more developing and emerging markets in the Middle East and Africa, then you see similar stages of development perhaps to some of the Asian countries, but maybe even further behind. And what we have seen there is some quite major steps being taken place when the risk-based capital is introduced for the first time. We've seen companies, a significant number of companies in some markets being below the minimum capital requirements. And that's having quite an impact on companies in terms of how they plan, how they expect to continue to operate. We've seen companies rushing to merge. But we've also seen regulators take a more balanced view and say, well, I don't want 80% of my market going out of business overnight and the disruption that will cause. So a lot of time you get the degree of regulatory forbearance, or you get slippage in timetables. So, but the general direction of travel is very similar.
Okay, thanks. Right, Christy, the Northeast Asia picture is different.
Yeah, I will cover Hong Kong and South Korea from the slides. Hong Kong, I will first mention that Hong Kong is a really small market is a very small and fragmented market with over 80 players. And in the non-life market, while the biggest one only have about 7% of the market share. And so when the regulator is playing regulation catch-up, moving from Solvency I to RBC regime, they're planning to first implement the Pillar 2, the quantitative assessment next year, and with the Pillar 1 will be delayed to around to 2022. However, this is adding a lot of cost pressure to the small players, combining with IFRS 17 and other ERM requirements, where especially there are a number of players who have small net premium bases as they're playing a fronting role, where when there's consulting costs add to the management expenses, improving the IT systems, and also adding key people to fulfill the regulations. All these add up to increasing management expenses on a small net earned premium basis. So it's adding pressure to the operating performance blocks when we're reviewing the credit rating. On the other hand, for South Korea, which is a much bigger market, they are also going to implement a new solvency regime called KICS, together with IFRS 17 implementation by 2022. Both of these are always being commented together, because both of them are going to use the market consistent rate to evaluate the insurance liabilities. So I think we have to first go over why the non-life insurance market is more being impacted by it, because of the unique nature in the South Korea market. There's about 70% of the premium are coming from long-term policies. So there are long-term policies that's covering personal lines such as PA or health, savings, annuities. So there's some overlap with the life market. With the long-term features, when you're using a market consistent discount rate, then it will make the liabilities higher. And also there's a lot of uncertainties of what's the final KICS regime will be like, that make the insurance company want to be prepared in terms of the capital position. We observe that there are insurers who are raising subordinated debts or hybrid bonds to improve the capital positions. But on the other hand, that's also increasing interest commitment burden to them, where make them to more focus on the operating performance to deliver the commitment. So the industry is evolving because of the regulation change, where they are reforming their strategies, switching from saving type focus to more protection type focus, as well as focusing more on asset liability matching. And also there are like investment-wise, they are also going a little bit more aggressive, investing more in alternative investment to boost up the investment return under the current low interest rate environment. Overall, I think the South Korean market, until like the market have a more clear picture of what the finalized KICS regime will be required the industry, I think the industry are ongoing improving themselves in terms of capital position as well as reforming the strategy.
Thanks, Christy. I've got a question on Korean RBC, South Korea RBC changes and whether reinsurance can come into play for providing capital relief.
I think that's a very good question. Reinsurance is always, a capital solution to insurance companies. And currently, I think there are some life insurance companies and reinsurers are lobbying with the regulator to relax the regulations, to allow the industry to use co-insurance to cede some of the interest rate risk to the reinsurers in order to lower the burden on the regulation change. So I think it's very important to see how this evolves, whether the regulation would allow some major change in the reinsurance space.
Okay, thanks. To Miles, a methodology question.
Sure.
Slightly off the topic, but it's what we do. Will there be any difference in approach and rating methodology in rating a virtual pure online insurance company versus a traditional insurance company?
That's a good question. So I think it comes back a little bit to what Greg was talking about at the start in terms of data analytics and a wider piece around innovation. So our methodology essentially is applicable for all insurance and reinsurance companies that we rate, all different sizes, business formats and otherwise. So the key fundamentals of our financial strength rating does continue to be that balance sheet strength, that operating performance, the business profile and ERM. I think if you do have particular competitive advantages that come from the formats that you've chosen to operate under, be that technology driven or otherwise, that's something that certainly does play into the business profile component, and going forwards, as many of you will be aware, with our innovation criteria is something that will be more formally embedded into our analysis as well.
Thanks, Miles. And Greg, this is probably a question that Herbert Fromm might have asked you this morning. How can traditional CAT models be relied on using stochastic methods based on historical weather data when the climate system is changing dramatically?
Okay, well, first of all, I want to clarify that I'm not a CAT modeller and I don't work for either of those firms. A tough question. It's the answer I'm struggling with. I think my understanding of how the models work is the providers allow their users and their subscribers to actually use the model in a number of different ways. So you can calibrate the model using the historical data, but you can also then factor into the models some assumptions about future CAT activity, future impacts of climate change, etc. So I think I'm not normally one for defending the CAT modelers because they're easy to pick upon. But I think that they do have that flexibility built into their models to assess not just where we are today, but where people think things are moving in terms of CAT activity.
Okay, thanks, Greg. Right, let's move on to...
Okay, actually I just wanted to just make one comment about the last two slides in terms of the impacts of risk-based capital, and just to draw that back to the opening slide that I used to explain our methodology. And I think we've hit some of these points, but I just wanted to re-emphasize it. Generally, where we see capital standards being raised or regulatory expectations being raised, the impact is often positive for balance sheets in the longer term. It can be negative in the short term if companies find themselves below the regulatory requirements, or they find themselves suddenly recognising the risks that were really there in their books of business but that they hadn't really recognised in the past. The short-term impact on operating performance can be negative, as the additional costs that my colleague spoke about, as companies have to gear up for a more sophisticated approach. And then the ultimate longer-term positive would be under enterprise risk management, as companies become more attuned to the risks that they face and the challenges of their business. So overall, I would say risk-based capital, the shift to improve risk-based capital regimes is a credit positive for the markets that we cover.
Greg, while you're on your feet, just a quick one back on the original slide about the block methodology.
Yep.
There was a question about, do the rated clients have transparency on each block?
They do. We disclose that to our clients. It's also effectively disclosed in our press releases and credit reports. So we use some keywords to describe the operating performance, the business profile, enterprise risk management. So if you go to the final rating, you can then unpick the building blocks and take you back to our balance sheet strength assessment. We also use a keyword to describe that as well. So it's pretty transparent, not just to the rated entities, but also to anybody looking at our press releases.
Great.
Okay. So I know we've passed 3 o'clock now, so we've just down to the hardcore committed people that really want to know about IFRS.
Well, we've had several questions.
17.
I'm surprised.
Actually, we mock this, but 2 weeks ago I was in the Middle East, in Oman and Dubai, and we held similar seminars, and we had dedicated sessions on IFRS 17, and it generated more questions than any other topic. So accounting topics generally aren't the things that keep people awake at 3 o'clock on a Thursday afternoon, but this is an important issue for the industry. So this slide we borrowed this from Milliman, who partnered with us in Oman actually to talk about this subject, in terms of how well prepared the industry is. And I can't remember, I think IFRS 17 it was called IFRS 4 Phase 2 at the time, was first being talked about in 1999 or possibly even 1997. So this has been coming for 20 years, and by the time it's implemented, it'll be almost 25 years in preparation. So you can understand why people might lose interest in it, but actually it's quite a radical change potentially, particularly for long-tail writers and life insurance companies. It's quite a radical impact on how companies report their results. And the question we get asked is, well, what's going to be the impact on ratings? And I think our view would be, well, our ratings are trying to look at the true economic situation that a company faces. And actually IFRS 17 is trying to move to a more of an economic outlook. I mean, one of the fundamental failings of how companies report today is one of the key metrics is net premium, or even gross premium, but let's focus on net premium. And everybody uses that as a proxy for risk. If you double your net premium, you've doubled your risk. Well, actually you can halve your net premium just by halving your prices, and your exposure hasn't changed. You've now just got half the money to live on. So net premium is fundamentally flawed as one of the industry's key metrics for measuring risk, and that's been the backbone of Solvency I analysis and fundamental to Solvency II calculations. So actually IFRS 17 is a big step in the right direction, but of course it's a big change, and getting people used to that and the impact that potentially has on observers like us is significant. But if you buy into the theory that the economic reality doesn't change, then you'd say that ratings wouldn't change. The only problem with that is IFRS 17 will cause companies to think again about the types of product that they write, how they structure their products. And products that have profits that emerge only over a very long period of time, or only at the end of maturity of the product, will become less attractive to be reported under IFRS 17. So what we may see is, the law of unintended consequences. Companies change their product design, and perhaps long-tail products become less attractive, or they become non-insurance contracts, so they fall out of IFRS 17 reporting. And that then has an impact on the risks that the insurance industry faces, and therefore will have an impact on the credit ratings, creditworthiness of that sector. So we've put this slide up. It's a slow train, but it's coming, and it's going to have an impact. What I wanted to do was get an image that had the insurance industry tied to the rails down here as the train was approaching, but Scott wouldn't let me do that.
No.
It is a big issue.
I've got a question. Maybe this is for Christy because it touches on Korea. What's the impact of IFRS 17 and KICS being implemented simultaneously? Mayhem?
I think it's too early to say because for cakes is still going through quiz and it's not yet finalizing. The insurance industry is lobbying really hard with the regulator to make it a soft landing instead of hard landing. I think it's more like it's hugely impacting the life side, where non-life side, although its impact is better because they have shorter history of long-term policy and they don't have a large portfolio of high guarantee rates from the past. So I think overall it's still quite early to say, but definitely the market is getting ready for the worst case scenario.
Okay, thank you. We've answered all the online questions. I know it's just past 3. We started a little bit late. Apologies for that. Thanks for joining us today. We really appreciate that. We really want to get this message out, messages in plural. There is a disclaimer. You can read it at your leisure.
It's 2.
It's quite long.
2 for the price of 1.
It is. It is. I'd like to thank Christy, Miles and Greg, and also like to thank the AM Best team from Singapore for helping to produce today. Thank you for coming, and I hope you enjoy the rest of the conference. Thank you very much.